Bitcoin. The very word evokes a sense of mystery, excitement, and perhaps even a tinge of apprehension. Since its inception in 2009, Bitcoin has gone from a niche concept discussed in online forums to a global phenomenon, capturing the attention of investors, governments, and everyday individuals alike. But what exactly is Bitcoin, and why is it so significant? At its core, Bitcoin is a digital currency, a form of money that exists solely in the digital realm. Unlike traditional currencies issued by governments, Bitcoin operates on a decentralized network called a blockchain. This means that no single entity controls Bitcoin, making it resistant to censorship and manipulation. Bitcoin's emergence marked a paradigm shift in the financial landscape, challenging the established order and sparking a debate about the future of money. Its decentralized nature, coupled with its limited supply, has led many to believe that Bitcoin could revolutionize how we think about and interact with money. The story of Bitcoin begins not with Wall Street financiers but with a group of cypherpunks, privacy advocates who believed in the power of cryptography to empower individuals and challenge centralized control. In the late 1980s and early 1990s, these individuals laid the groundwork for what would become Bitcoin, developing cryptographic protocols and digital cash systems that aimed to create a more private and secure financial system. In 2008, a mysterious figure or group operating under the pseudonym Satoshi Nakamoto published a white paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. This groundbreaking document outlined the technical specifications for a new digital currency that would operate independently of any government or financial institution. On January 3, 2009, the Bitcoin network went live, and the first block, known as the Genesis block, was mined. This marked the birth of Bitcoin and the beginning of a new era in finance. Central to Bitcoin's functionality is the blockchain, a revolutionary technology that underpins its decentralized and secure nature. Imagine a digital ledger distributed across a vast network of computers that records every single Bitcoin transaction ever made. This ledger is constantly updated and verified by computers on the network, ensuring transparency and immutability. When a Bitcoin transaction occurs, it is broadcast to the network and added to a block. This block is then linked to the previous block, forming a chronological chain of transactions, hence the name blockchain. Once a block is added to the blockchain, it cannot be altered or deleted, making Bitcoin transactions highly secure and resistant to fraud. The blockchain's decentralized nature means that no single entity controls Bitcoin. Instead, the network is maintained by a distributed network of computers, each with a copy of the blockchain. This distributed consensus mechanism ensures that no single point of failure exists, making Bitcoin highly resilient to attacks and censorship. One of Bitcoin's key characteristics is its limited supply. Unlike traditional currencies, which can be printed infinitely by governments, Bitcoin's creation is governed by a predetermined set of rules written into its code. Only 21 million Bitcoins will ever exist. This scarcity is a fundamental factor driving Bitcoin's value. As demand for Bitcoin increases and the available supply remains capped, the price of Bitcoin naturally rises. This principle of supply and demand is a cornerstone of economics, and it applies to Bitcoin just as it does to any other asset. Furthermore, Bitcoin's code dictates that the rate at which new Bitcoins are created, a process known as mining, will gradually decrease over time. This means that Bitcoin's scarcity will only increase in the future, potentially further driving up its value. Bitcoin as a speculative asset, volatility and price swings. Bitcoin's price has been nothing short of volatile since its inception. It has experienced meteoric rises, followed by precipitous falls, often in short periods. This volatility is a double-edged sword, attracting traders and speculators seeking to profit from price swings, while also making Bitcoin a risky investment for the uninitiated. Several factors contribute to Bitcoin's price volatility. The relative novelty of Bitcoin and the nascent stage of the cryptocurrency market mean that prices are easily influenced by news, speculation, and market sentiment. Additionally, the limited liquidity of the Bitcoin market, compared to traditional financial markets, can exacerbate price swings. While some investors are drawn to Bitcoin's volatility, seeing it as an opportunity for profit, it's crucial to approach Bitcoin investments with caution. The potential for high returns is accompanied by an equally high risk of losses. The case for Bitcoin: decentralization, security, and transparency. Despite its volatility, Bitcoin offers several compelling advantages that have attracted a growing number of investors and advocates. Its decentralized nature, security, transparency, and potential to disrupt traditional finance have led many to believe that Bitcoin represents the future of money. Decentralization is at the heart of Bitcoin's appeal. Unlike traditional currencies controlled by governments and financial institutions, Bitcoin operates on a distributed network, making it resistant to censorship, manipulation, and single points of failure. This has profound implications for individual freedom and financial sovereignty. Bitcoin's security is another major draw. The blockchain's cryptographic design and decentralized consensus mechanism make it incredibly secure. Bitcoin transactions are virtually tamper-proof, and the network has proven to be remarkably resilient to attacks. Moreover, Bitcoin offers a level of transparency unmatched by traditional financial systems. All transactions on the Bitcoin blockchain are publicly viewable, promoting accountability and reducing the potential for fraud and corruption. Potential risks of investing in Bitcoin: regulation, volatility, and competition. While Bitcoin holds immense promise, it is essential to acknowledge the potential risks associated with investing in this emerging asset class. Regulatory uncertainty, market volatility, and competition from other cryptocurrencies are all factors that could impact the future of Bitcoin. Governments worldwide are still grappling with how to regulate Bitcoin and other cryptocurrencies. Regulatory changes, such as taxation policies or restrictions on trading, could significantly impact the price of Bitcoin and the ease with which it can be bought, sold, and used. As discussed earlier, Bitcoin's price volatility poses a significant risk for investors. The potential for rapid price swings can lead to substantial losses, especially for those who are new to the market or who invest without a clear understanding of the risks involved. Bitcoin also faces competition from a growing number of other cryptocurrencies, some of which offer features or functionalities that Bitcoin does not. While Bitcoin remains the dominant cryptocurrency by market capitalization, the emergence of competitors could potentially erode its market share and influence its future value. Bitcoin in 2024: adoption, innovation, and the future. In 2024, Bitcoin continues to mature as a technology and an asset class. Adoption is on the rise, with more businesses accepting Bitcoin as payment and institutional investors increasingly adding Bitcoin to their portfolios. Innovation within the Bitcoin ecosystem is also accelerating. Developers are constantly working to improve Bitcoin's scalability, security, and functionality, exploring new technologies such as the Lightning Network to enable faster and cheaper transactions. The future of Bitcoin remains uncertain, but one thing is clear: it has already disrupted the financial landscape and sparked a global conversation about the future of money. Whether Bitcoin will become a widely adopted global currency or remain a niche asset class remains to be seen. Is it too late to invest in Bitcoin? Weighing the pros and cons. So is it too late to invest in Bitcoin? The answer, like most things in finance, is not a simple yes or no. It depends on your individual circumstances, risk tolerance, and investment goals. If you believe in the long-term potential of Bitcoin and are comfortable with its volatility, then investing now might still be a viable option. However, it is crucial to approach any investment in Bitcoin with caution, conduct thorough research, and never invest more than you can afford to lose. On the other hand, if you are risk-averse or uncomfortable with the volatility of the cryptocurrency market, then Bitcoin might not be the right investment for you. It's essential to carefully weigh the potential risks and rewards before making any investment decisions. Your Bitcoin journey starts now. Bitcoin has come a long way since its humble beginnings. From a white paper published by an anonymous creator to a global phenomenon, Bitcoin has captured the imagination of millions and challenged the very foundations of finance. Whether you decide to invest in Bitcoin or simply follow its development with interest, there's no denying that Bitcoin has sparked a revolution. It has shown the world the transformative potential of decentralized technologies and opened up new possibilities for how we think about and interact with money. Your Bitcoin journey starts now. Educate yourself, explore the technology, and decide for yourself whether Bitcoin has a place in your future. Did you find this video informative? Let me know your thoughts on Bitcoin in the comments below. And don't forget to like and subscribe for more videos on Bitcoin, blockchain technology, and the future of finance.